Welcome to your financial journey, the April Wealth Advisory Review. I hope you've had a great month so far. I know one more week is tax time and everybody's trying to get all their tax information together. Some of you have already filed your taxes because you're getting refunds. Some of you are holding off to the last minute because you're not prepared. And some of you are extending because you have more to get together, plus you're going to have to pay. And so you're trying to extend that as much as possible. Just as a reminder, and I'm not giving tax advice because I cannot, you do have to pay all of your taxes before April 15th, even if you do extend, but you can confirm that with your accountant to make sure that's accurate or not. As I said a moment ago, welcome to the April Wealth Advisory Review, where we're going to take some time to update you on markets and economies, as well as do a little more sharing with you about our process here at Frank Reynolds and Company, how we manage portfolios for your benefit, for your family's benefit, and for future generations. As always, a reminder of the important disclosures. If I talk about things that bounce into tax issues, please review this with your accountant or tax preparer. If we talk about things that bump into legal matters, please review those with legal counsel so that you can make sure this makes the most sense for you. And if we talk about investment ideas, please make sure that they match your needs for income, for growth, for your risk tolerance, for cash reserve or flexibility. Whatever those items are, please make sure it matches. And anything we can do to help answer any of those questions, we'd be happy to help answer that for you as well. As always, towards the end of the presentation, I will update you with a chance to ask questions or maybe even get on camera and do a chat if you'd like to, but you can certainly raise your hand or chat your question in the box. Be happy to answer that for you as well. So tonight we have kind of a full jam-packed discussion, and so I'm going to get into it right away and hopefully be able to get through everything in a timely manner. Our usual end time at 6:30 or sooner if possible. So tonight we're going to continue our discussion about your investment allocation blueprint strategy, the process we use to help clients manage money. We're going to take a look at the risk tolerance investment processes. We're going to look at diversifying your strategies and how critical that is. Take a look at dollar cost averaging, and it's still a great strategy. And I'm going to show you some information on that tonight that I think will knock your socks off. We'll take a look again at cyclical asset management and how important that is as a process. Weighting in your portfolio asset allocation modeling, and the importance of utilizing entry and exit strategies in your portfolio management as well. I'm going to do a little different tonight. I'm going to save the market and economic review for after I've gone through the blueprint strategy discussion. And finally, we'll take a look at the wealth advisory final thoughts I have for you and answer questions, and then remind you of what's coming in the next month or so. So with that in mind, let's get into it. Oh, there's that little spinning ball of death again. Oh, hopefully this is going to be quick. It was. Let's back up a second. Yep, perfect. Okay. So as you have seen this slide many times, the last couple of months, I've spent a lot of energy going through it in detail, talking about the 8 asset types, and then talking specifically last review and this review about these 10 strategies we use in there. Last time I spoke with you about cash reserve needs, how we look at income to growth ratio, probability versus surety planning, tax management, and I started on risk tolerance, but I've extended just a few more pieces today to do that. And then I want to take from there, after we taken a quick refresher on your risk tolerance, to then take a look at diversification, dollar cost averaging, cyclical asset management, weighting, and entry and exit strategies. So with that in mind, a quick reminder of risk tolerance. Everything you and I invest in is going to come in one of 3 buckets: no or low risk, a moderate risk, or a high risk. In the high risk, we're looking at a lot of volatility, conceivably, higher return potential, hopefully, and a higher chance of loss. Factor to sort of think in there if you're not a risk, if you don't have a high risk tolerance and you're more risk averse, we want to stay more careful about higher risk assets. Moderate risk, which is limited protection options, moderate volatility, limited liquidity, access to your principal because of market forces, and then moderate return potential. And then finally, no or low risk, guaranteed returns, no loss provisions, high liquidity, and lower return potential. And the no loss provisions means that most of the no risk investments we're going to look at would have no loss ability in them. Some might have a low loss potential. Now, we have used a software called Nitrogen, formerly Riskalyze, to help our clients identify where they sit on that scale. It's a calculation or a calculus, if you will, that goes from 1 to 99. And that 1 to 99 puts you on a score, 1 being completely risk averse, 99 being totally risk taker thinking, and somewhere in the middle. And when we apply that risk number, as in this example here, a 56, we apply that risk tolerance to your investment portfolio, both those assets you have with us, as well as those assets that you hold outside of us, to make sure that you are not surprised by market downturn. And that really is what the risk tolerance scoring is about, is to make sure that if the market goes down, you are confident in your planning process and your asset access process, that you're not losing sleep at night. We even take that information and we can, on a more personalized basis, come over here and compare your existing portfolio management strategies to items like, well, what happened if we were in the 2013 bull market again? Or if we had the 2008 bear market, how would your portfolio look then, based on how it's set up today? What if the financial crisis were to happen? How would your portfolio fare in that? And then what if we had 1 1/3 interest rate increase, which happened last year, where we're able to identify what the markets can do when we're having rate increases at a rapid pace. So with that in mind, we use this strategy to help our clients understand their risk tolerance and then to match their portfolio up, both those assets we manage for them and then the assets that are managed outside of us, to their risk tolerance, to make sure they're on pace for meeting their financial goals, whether that be growth or income, cash reserve, liquidity, flexibility, and most specifically to match their risk averse or risk taker nature. Now, with that in mind, some of the strategies we look at would be diversification, not putting all of your eggs in one basket. The 8 buckets that we work with here, they cover the universe of what is available. They may not have every single investment in them, because there are some companies that they have set their assets up so you have to work only with them to be able to use it. So those companies we can't bring into the mixture, but 95+% of the companies that you and I would want to invest in are free agents and allow us to work with them. So whether that's a cash reserve account or bonds or bond funds, equities, stocks or stock funds, real estate and the various types of real estate, tangible assets like precious metals, industrial metals, energy, commodities, currency, the US dollar versus the world, and now with the advent of certain ETFs, some crypto opportunities as well in those portfolios through the exchange traded fund modeling. Private business interests. Several of the companies we work with make it so that we can get to companies that are privately held, not publicly traded on any of the stock indexes or markets, but give us opportunity for income growth or both for those portfolios. And then finally, utilizing insurance and annuities as ways to model any one of the other 7 buckets, but to do it with protections built into it that can protect income or capital or both in the event of market downturn. Now, when we look at diversification, and in order to understand how we could manage so many clients' money, we really work with 4 profiles. Now, we could include an income-only portfolio. We could include a cash reserve-only portfolio, but we don't really do that normally. What we do, though, is look at having a portfolio that's either an income and growth portfolio, a conservative growth portfolio, a growth portfolio, or an aggressive growth portfolio. So while we might have access to 6 different portfolios, for the majority of the cases, and when I say majority, I mean 98+%, we're doing one of these 4 or a couple of these 4: income and growth, conservative growth, growth, and aggressive growth. And we're building that diversification model with your needs in mind. And that's not just a platitude. We really try very hard to make sure that we are understanding what your needs are, and then to build a portfolio that matches your investment style and meets your needs for cash or income, access to money, flexibility in case things are changing for you, and within your risk tolerance at the same time. So that's what we do with diversification. And while that kind of captures everything in a nutshell, I assure you there's no two portfolios that we have for any of our clients that are exactly alike. It really is a very unique thought process that even though two of you, for instance, might think, well, I'm conservative growth, that may be true, but you might have different income needs. You might have different cash reserve needs. You might have different tax management needs. You might have needs different for flexibility to help family out or to give to charity, etc. There are many variables that change how these mixtures are set up. And so while we start out with a foundational basic, we really do move quickly into the specifics that match our clients' needs through a diversification thought process. Now, when I say diversification, there's a Dalbar chart this comes out every year that shows how different asset classes, their returns work within periods of time over years. And again, not just putting all of our eggs in one basket or even just dividing them up among a number of different asset classes. What we're really trying to do is to stay on top of how we might weight those portfolios out based upon a client's risk tolerance and based upon their other investment needs as well. To explain that differently, let me do this. I'm going to actually take you to that website and show you how this works. So hopefully you can see this pretty easily. So what we're looking at here, and the reason these boxes are so colored is they represent different asset groups. I know this is kind of small, but this is large cap down here. I'm looking at large cap. Here's small cap, international developed markets, emerging markets in international emerging markets index, real estate investment trusts using real estate as an investment model, high grade bonds, high yield bonds, cash, and then finally different asset allocation portfolios. And so what I can do is I can click on any of these boxes. So for instance, let's say we wanted to see what large cap stocks had done. So what we can see here is the orange, which is now highlighted. In 2009, it was in the bottom 50 percentile, but it began to move up. So by 2011, it had moved up. It still wasn't the top, but it had moved up. Then it moved down in 2012. Then it moved up in 2013, 14, and 15. Then it went down a little bit in 2016. When I say down a little bit, it still performed 12% that year in 2016. Large cap then did 21%, almost 22% in 2017. Large cap dropped a bit, went to a negative 4.4 in 2018. And then it was a star performer in 2019 at 31.5%. And then we had 18.4% in 2020. And then 21, it did 28.7. Then 22, it did a minus 18. And then 23, it did 26.3%. That's large company stocks, large capitalization companies, companies like the Dow and the S&P 500. Not all the S&P 500, but a good chunk of them. And the average for that group of assets was 10.6%. And I'll direct your attention over here where year to date, this is looking so far this year, it's at the top of the charts as well. Now, comparatively, let's take a look at real estate. And I'd like to point out, real estate is another great investment. I know right now it's not at the top, but if you go back to 2009, you can see in 2009 did 28%. I know that might be hard to see, but I assure you I'm looking at it right now, it did 28%. 2010 did 28%. 2011 did 8.3%. And even though it's only 8.3, it's the top performing asset in that year. 2012 was 19.7%. 2013 went down, it was only 2.9%. 2014, and I could run through these, but what you'll see is that the average on real estate trusts has been about negative 1.3. I'm sorry, not the average. The year-to-date number is negative 1.3, but it has consistently been a high single or low double-digit performer. And so while it's not doing as well right now with interest rates a little bit higher, As the Fed looks at lowering interest rates, which there's an expectation they might lower rates 2 or 3 times this year, if that happens, that may be enough to kick the real estate market into a little faster pace at that point. Now we can look at many other things. For instance, small company stocks. Small company stocks, you can see how often it's been near the top. You can see where it's at year to date. We can take a look at international developed stocks, countries like Europe, countries where they're fully developed, fully mature. We can see how they're performing. We can take a look at emerging markets, smaller countries, or maybe not smaller in size, but smaller economies like India, for instance. Big country, not as developed a market there. So we can run through each of these groups and see various items. This is high grade bonds. Here are high yield bonds. And we can see where they come and go over time. And then if we look at asset allocation, and this is what I wanted to close off with on this chart, what this is taking a balance of all of them and saying, well, if we just, instead of trying to pick out the right one, what's going to be the top this year, which is impossible to choose. Hopefully after the last few months, I've been able to prove to you that it's very difficult to always time it or pick out the right asset group. But if we do an asset allocation model, we should be able to see some decent returns. If we're looking here, asset allocation back in 2009, 24%. Take a look when the markets were starting to come back, 12.2%. Here in 2014, 6.9%, down 1.3%, down 5.6%, up 9.8%, and year to date is about up 2.8%. That's a mixture of all the assets together. So with this in mind, this is another reason why we do diversification, because it's impossible or very challenging to choose the right asset group. But if you have your assets divided up among multiple different asset groups, you're going to have some that are going to be winners and some that aren't. And that's going to make it so that you can, as you average out, have a little higher return. These returns are healthy. There's nothing wrong with these returns, and they help us to make sure that our clients are able to meet their short, mid, and long-term goals. Now, having said that, let's go back to the review. Sorry, it's down here. So we use this to help get people into the right mixture for them. Now, that's going to bring us to another discussion here shortly called weighting and weighting, and how we weight, W-E-I-G-H-T, various asset groups, and then how we wait for that cycle to come back. And I will remind you of this in a minute. But for now, let's go ahead and take a look at the next idea, dollar cost averaging, which is a very old idea. I mean, it's very old. I got in the industry in 1986, and it was one of the first things I was taught. It's a very old idea, but it has not lost its value. And I'm going to show you a little bit about that today to kind of help explain that. But what is dollar cost averaging if you've never heard of it before? It's an approach to purchasing investments in which the buyer spreads out their purchases so the total price paid is less affected by market timing. So that, for instance, if you buy in on day one and the share price is at $10 and you were putting $100, you'd buy 10 shares. If the next week it's up to $12, which wouldn't normally be that high, I'm just using this to give an illustration. If it's up to $12, you're not going to buy 10 shares, you're going to buy 8 shares. And if it's down to $8 a share, the following month, you're going to buy more shares, 12. And so what's going to happen is over time, you're going to average those purchases out so that you end up with hopefully a higher average. Now this, as you're about to see, only really works well in volatile markets. If you were to take, as you'll see in a moment, and invest a lump sum of money in a market where it's just going up, you'd be wiser to go ahead and invest the lump sum. But if you're investing in markets where it's volatile, you'll see that it's probably better for you to go ahead and buy in through a dollar cost averaging model. Now, the real issue is nobody knows. We think we know what's going to happen with the markets, but if you're concerned about volatility, then using dollar cost averaging or over a 12 to 18 month time frame can be a great way to help you minimize risk while getting advantage of those opportunities and gains. Now, what do I mean by that? Well, so I'm going to actually take you to this website and show you some examples of this. But what we're doing here in this is we're comparing $35,000 investment, one done as a lump sum, and one done as a systematic investment. And what we're going to do here is in this one, and this is going into the SPY, which is the exchange traded fund for a spider with the S&P 500. So this is like buying into the S&P 500. And I started this, you can see it, it's January 22, and I ended it in February of 24. Now, over that period of time, I started on this one here, and I said, well, let's just put in $35,000 one time. And so over that $35,000, and if you look at how the S&P behaved, what you're going to find is it went down, and it did that in 22, and then it came back up in 23. And so what happened was, my cursor, there we are, we invested $35,000. Our $35,000 grew to $36,976, so it's about a $1,976 gain over that period of time. That's about 5.65%. Now again, I added nothing. I just put 35,000 in one time in this calculator. In the bottom chart, I put in 10,000 up front, and then I put $1,000 a month in over the same number of months, January of 22 to February of 24, which means I put in a total of $35,000 of investment. That same $35,000 of investment, by buying in at times when the market went down and buying more shares, and when it went back up, buying less shares, I ended up with an account value of $40,143. I had a $5,100 gain, and I had a 14.7% average annual return. And so dollar cost averaging is a way that if you're looking at some investments that you're thinking, oh, I think I would like to get in, but I'm really concerned about market volatility, you don't have to pull from your monthly money. We could take a part of your portfolio and set aside, and I'm not making this as a recommendation, I'm just using it as an example, but you could say, I want to take $50,000 and set it into an account, in a cash account, and I want every month for that to move $2,500 over. So that on the months when the share price is higher, I buy fewer shares, and on the months when the share price is lower, I buy more shares. And then by the time we get to the period where that whole $25,000 or $50,000 is invested, we'll now see what the returns are. Now again, as you'll see in a moment, if the market went straight up, you're going to wish you had just put it all in early on. But if the market was volatile and had good and bad times, you're going to be more happy. You're going to be happier, I believe, because you will have seen that value work in that way. So let me go to that calculator and show you how that looks. So this is the dollar cost average calculator. And in this example, this is one where I took and I just created a separate model here. I said, well, what if we had put in from January of 2022, we started with $0 and we put $3,000 a month in. And we did that until February 2024, just like I said a few moments ago. During that period of time, we would have invested a total of $75,000. The account value today would be $88,737. We'd have $13,737 of gain and an average return for that period of time of 18.32%. Now, to put things correctly, let's say I take that $75,000, and instead of doing it like that, I just simply put the $75,000 in one time. And let's take out this $3,000. So now put in the same $75,000, and we end up with the same kind of time frame here. $79,000, 5.65%, a $75,000 investment. And what I was illustrating a moment ago is you can see that every month we made investments. When the share price went down, we purchased more shares. And as you can see here, when it went down here, we bought a lot of shares. And then it started moving back up. And then by the time we got to the end here, which is roughly the same value from January of 22 to February of 24, roughly the same price point in the market at that time. But now let's say that instead of doing 22, I take this back to 2012. Oh, sorry, it's only let me do 2014. There we go. Okay, so we've still put the same $75,000 in. We had a 219% gain and today our portfolio is worth $239,000. I would also caution and say that unless you started in January of 2014, put that money in and left it alone, if you pulled income out, you wouldn't have seen that. If you pulled money out to pay taxes, you wouldn't have seen that. It would have all been different. But this is just saying January of 2014, put the money in, leave it, and walk away. And we're looking at 10 years time frame. And so that's what you would have seen on that portfolio. Now, I'd also like to point out the reason I'm doing this is you can see that aside from just a few pullbacks here, this would be 2020 for March when the pandemic hit. And then we had the more recent one here where the interest rates hikes happened. We can see that our $75,000 did pretty well. Now, let's see, how am I going to do this? So that's going to be for 10 years. $1,000 a month is still going to be too much. Let's take this and take it to zero. And let's do $500 a month. Okay, let's do one more time. 750. Okay. We're kind of in the ballpark. It's a little bit low. If I change it, we'll do one more here. 700. All right. So we can see that we had 93%, not 219, and we only have 160,000. And the reason is, even though it's actually a little bit more money than what I was putting in a moment ago, the fact is that we had a lot of time in there where the markets were moving up. And so the share price would have been better to buy it cheaper back here because you would have had all kinds of gain opportunities here. Again, if you're not quite sure of how the market's going to go, if you have concerns about volatility or market downturn, using dollar cost averaging, which is an old idea, still has huge, huge value. And with this calculator, I can run all kinds of different securities, not just an index, but various stocks as well. So if you're in the office next time, you want to see this, how this could work for you on choosing an index, an ETF, choosing some different securities, I'd be happy to show you how that would work. Because again, dollar cost averaging is one of those great tools that we use every once in a while with people, but it's not anything I have anybody asking about, and yet I think it's still an amazing investment opportunity. So if we're going to use dollar cost averaging as another one of the strategies in our portfolio mixture, you can see that in volatile times, and this wouldn't be for the entire portfolio, this might just be for a piece that you want to go a little more aggressive on, or some securities that you're not quite sure about. I have a number of people now talking to you about artificial intelligence, AI stocks, and I keep encouraging them to think about taking a chunk of money and do dollar cost averaging, because when they go down, and they will, not because they're bad, but because as the market changes, if we have a downturn this year, stocks that aren't fully mature are going to take it harder. They're going to have a bigger hit. But that means if you're doing dollar cost averaging, you're going to buy more units, more shares, and that could really work in your favor. As an idea, it really is still a great idea. Now, with this in mind, it brings you to the cyclical nature or the cyclical asset management approach, and understanding that everything has a cycle to it, a cyclical nature of the environment as well as stocks and other investments. And simply put, we think of it as everything has a peak and a trough, an early downturn and an early upswing, and a full upswing and a full downturn, and then we cycle through again. And I've shown you that with different types of asset modeling that we do in previous meetings, previous reviews. But let me put it in terms that might make a little more sense. If you think about it for a second, for instance, cash reserve, which is going to be attached to interest rates. If we were sitting here and you were sharing with me right now, and I said to you, where do you think interest rates are right now? Do you think interest rates are at the peak, or do you think they're at the trough? You probably have some opinion. You may not, you may be more right than I am, to be honest with you, but you have an opinion whether you think interest rates are at the top and going to go down, or whether they're at the bottom and going to go up. Or maybe they're somewhere in the middle. Maybe they're on the way down, or maybe they're on the way up. You have an opinion. And that opinion is how we start the discussion about managing money. So for instance, let's say that with interest rates and using cash reserve, if you said to me, I think they're at the peak, I would say to you, do you think that means they're at 12 o'clock? We'll call the peak 12. We'll call the trough 6 o'clock. Do you think they're at 12 o'clock? Do you think they're at 11 o'clock? Do you think they're at 1 o'clock? 11 o'clock meaning you think they might go a little higher. 1 o'clock meaning you think they're on the way down again. You see, that's a starting place for our conversation. I'll show you why that's important here in a minute. But that asset, cash reserve, CDs, money markets, understanding where interest rates are is an important part of this discussion, because when we go to bonds, for instance, would their valuations be at the peak or the trough? Would they be at 12 o'clock or 6 o'clock or some other number? Now, most people, when I ask this question, they say, I have no clue. I don't even know what drives bonds. Let me tell you, it's connected to interest rates. I mean, there can be other factors that might impact it, but if interest rates go down, bonds go up in value. And if interest rates go up, bonds go down in value. So if you said to me, well, I think interest rates are at the peak, that would mean that bonds are at a low point and would begin heading back up if interest rates start to go down. And that gives us some clues as to what some of our next moves should be if we're trying to manage assets appropriately. If you said that I think the interest rates are at 2 o'clock, meaning they're starting to head down again, that means we should start to see bonds move up in value. And if we see that, that should give us some ideas of how we might want to weight, W-E-I-G-H-T, a portfolio for more growth, income, or opportunity. Now, if we look at interest rates and bonds, the next area would be stocks. And if I said to you, do you think the stock market is at 12 or 6 or some other number? Again, you have an opinion, and all of us do, and your opinion may be right or it may not be, but it's that place to start that and say, well, how would I diversify my portfolio? If I think stocks are at the top, then I probably should be looking at other opportunities on how I manage it. This is how we do it, and I try to, as a person who's practicing a fiduciary standard, trying to say, how would you see this so we can then match it up, which is critical. We will do what we're supposed to as professionals, but we're not going to supersede what you say. You're the boss. We're the employees. I'm going to tell you everything that I know. I'm going to give you the benefit of all the information I have so you can make an informed decision. But in the end, if you say I'm just not comfortable with that risk, we're going to go with a lesser risk, even if I'm convinced it's not the best move. Because again, this is your money. You've worked hard for it. Our job is to help you understand what to do with it, to guide you in the process, to lead where we can, and then help you understand what opportunities you have next, or what we should do if things change on us and they're not going where we thought they would. So again, back to stocks, 12 o'clock, 6 o'clock, or some other number. The same thing's true with real estate. It has a peak and a trough. And with stocks, for instance, we have large cap and small cap, mid cap, we have growth and value and blend. With real estate, we have multifamily, single family, we have storage, we have A-class, B-class property, we have senior housing. There's all kinds of different real estate opportunities that exist out there as well. And they're cycling, just like sometimes on that previous chart you saw that large company stocks were at the top and smaller company stocks were further down, or vice versa. Same thing's true with real estate. Sometimes multifamily is doing a better job. Sometimes storage is doing a better job. Sometimes A-class properties are doing a better job. And sometimes they're not doing good jobs at all. But understanding that mixture, how that fits into this thinking, is when we look at real estate, would we say real estate is at the peak or the trough or somewhere in between? Is it at a 12 o'clock, at 6 o'clock, or some other number? And again, as we talked a moment ago, if interest rates are going up, it might make it harder to purchase real estate because it might be harder to get a loan that you can afford. So that might mean that real estate, if interest rates are high, real estate might be down more in the trough area, which means it has an opportunity to cycle and go higher. But it might not be this month, it might be 6 months. That's where the waiting and waiting comes in. Well, you get the picture now. So we now move to things like tangible assets, like energy and precious metals and industrial metals and commodities. Currency, when the interest rate is changing, it's also impacting the US dollar. Rising interest rates impact the dollar as a strengthening asset, and falling interest rates impact the dollar as a weakening asset. But understanding these pieces is critical. Now, business interests, which are more private, meaning that they're not publicly traded like a stock is, they're going to be impacted by the economy and the markets, but not the same way because they're not publicly traded. So therefore, they give us some opportunities to avoid some of that risk and give us the ability to have some growth and income or both to help our clients maneuver the markets and minimize risk. And it just depends on where you are in your financial investments, your needs, and so on, whether some of these programs will work for you or whether they really won't work. Now, finally, we have insurance and annuities. And insurance and annuities are simply all of these other models with riders or covenants put onto the contracts that can protect income loss, that can protect capital loss, that can protect a death benefit so that the value won't go down if the market does, make it so that you can have income with steady, stable income for your life. They can simply be modeled after some of these other buckets and have these stabilizers put in them. Back to our probability and surety discussion from last month. Putting these together in a different portfolio for each person is part of what our job is. And it might seem complex, but in reality, it's working with the very basics of what we're trying to do and then building on those basics to meet the client's needs, whether that's income or growth or cash reserve, tax management. Mixing these together is almost like a recipe. I'm almost like a financial chef, making everything come together for each client's needs. But there's a lot of similarities in the portfolio. They're just built differently to accomplish different goals, much like options you might buy in a car. One car does one thing, and the same car with different options does a little bit different. Same things here. But it starts with understanding the cyclical nature of investments. The asset cyclical management process is a big opportunity, a big piece of that. That's why this statement here says proactive wherever possible and reactive whenever necessary. Interest rates rising create one set of problems. The tightening of the US dollar creates other problems. The stock market falling creates other challenges. So what we try to do is to work through these opportunities to have a good set, stable model, but with the ability to make adjustments and to flex as we need to for our clients' ultimate goals of creating, growing, protecting, and preserving family wealth. And using this cyclical model for assets is part of how we do that. That brings us back to this chart where I said waiting and waiting. So if a client says, look, I'm a risk taker and we want to use, say, small cap, or we want to use international, or we want to use large company stocks, we can mix them and model them based upon that. And we can weight it, WEIGHT, towards the asset groups we think are going to do the best. Because at the end of a bear market, into a bull market, at the top of a bull market, into a bear market, certain asset groups behave certain ways. There are, I won't say it's hard and fast rules. It's kind of like art and science. There are rules that we can see happening over and over again, but those change over time based upon many factors that sometimes aren't obvious. But having said that, if we pick and choose assets, which comes back to a point here. So let's say, for instance, let's pick out something that wasn't so attractive. Okay, here's small cap. So small cap lost 4.2% in 2011. And so when we're sitting down with the client, we're like, we think we ought to go heavier into small cap. And the client says, well, how did it do last year? Well, it lost 4.2%. Client will be like, my goodness, why would I want to do that? Well, because we're not looking in the rearview mirror, we're looking out the windshield. And so consequently, the following year, 2012, it did 16.4%. And then 2013, it did 38.8%. Now, we didn't know what it was going to do. Nobody did. But we had ideas of what could happen because we'd watched what the markets had done. We had watched a 2010 good year, a 2011 bad year. We could see this. And you can follow along this chart and see different times where the assets are at the bottom, and that means there's probably going to be some turn up here, whether it's this year or the next year, but there's an opportunity there. But that means we have to drive looking through the windshield, not looking through the rearview mirror. That's where the waiting part comes in, WAITING. Because when we make an asset investment, sometimes we have to wait 6 months or 12 months or even 18 months before we're going to see that come back. And so if we are held to this standard that we have to be in the top row every time, we're never going to be the right advisor for you. But if we can choose a mixture that will help us to flex with good times and bad times, that will help us meet income goals and cash reserve needs, matching risk tolerance to your growth needs, then we can create a good mixture. And using cyclical asset management as well as waiting and waiting helps us to do that for a portfolio. Again, It's some science, but also it's some art too, trying to identify the right opportunities in the mixing to make everything work out in the best way possible, short term, mid-term, and long term. So that brings us to the last part here, is utilizing entry and exit strategies. If we are weighting, WEIGHT, assets into a group, and then we're holding on to them, or weighting, WAIT, we are going to have entry and exit points where we're buying in or we're selling out. Buying in because we think it's time, or selling out because we think it's time, or maybe it's because something really catastrophic has happened and we're trying to protect assets. But having entry and exit strategies is another part of that portfolio management. Now, this isn't day trading, and I assure you, I am so not interested in something that fast. It's just fraught with all kinds of challenges. If a client says to me, hey, can we do day trading? Absolutely. Here, why don't we take this amount of money? You can open up an account and you can play with it. Because the fact is that it's a lot to stay on top of that, and there are very few guarantees that such a thing like that works. If you don't believe me, then just simply think about this. If doing a day trading strategy was just a phenomenal plan and just worked really, really well, investment firms like Fidelity or Vanguard, they would have a fund that's all it does, is day trading. But they don't. The expense is too high, the loss potential is too great, the profitability is too low. So if they could do it, they would. If they could do it really, really well, they might only have one mutual fund because they wouldn't need anything else. If they got that one fund that could do it, that'd be all they would need. They don't. That's why they have literally dozens and dozens and dozens of funds to diversify the portfolio. So this is not about day trading. This is more about trend trading, and trends can go anywhere from 6 to 24 months. It's not a fast thing. It's in some ways kind of like watching water boil. You're waiting for that time and you're trying to make a decision based on all the information, all the data you have. Is this the right time to make an entry or an exit? And some people just don't have the patience for that. Some clients don't. So with that in mind, let me explain a little bit about it. While it's essential to determine the right investment strategy, and that's what I've been talking about this whole time, it's equally important to utilize a well-defined entry and exit strategy proactively wherever possible and reactively whenever necessary. This is especially crucial when it comes to bearish market environments where markets can be particularly volatile. Again, another reason why I talked about dollar cost averaging. That could be a good way to help offset this if we're not going to be able to maintain comfortable or well-defined entry and exit strategies. But if we can, then having those in place could be a great way to help with that process. A well-planned entry strategy can help investors determine a good time to enter the market, while an exit strategy can help them reduce losses or lock in profit. Now, when I say an entry strategy, let me just share something with you. I have a lot of clients who invest in real estate, and a number of years ago, a client told me something that I thought was just brilliant. What he said was, you never make your money at the sell. You always make it at the buy. And he was talking about real estate, buying houses. And he said, if you buy a house at the right price, you can put the money in it, and you have the freedom to sell it at your leisure. He said, if you buy it at too high a price, you're stuck with it, and you got to wait for something to change before you get out of it. And that same thing is true with everything we do. That's why we try to buy things on sale, because if you can buy it at the right price, you keep more of your money at work for you and you have the best opportunity. The same thing's true with investments and stocks and bonds and so on. If they're on sale, for instance, that makes them a good opportunity. And you maintain an exit strategy because of catastrophic concerns, and some investments like growth stocks require that much more importantly and essentially than, say, more conservative investments like high-grade bonds. But if you have that modeling in place and you're ready for it, you can lock in profits or minimize losses wherever possible because of market changes. While there's no perfect investment strategy, I would underline that there is no perfect investment strategy. I don't care what anybody trying to sell you anything says. I wish it were true. After 35 years of doing this, I would be very interested in seeing it myself. While there's no perfect investment strategy, having a well-defined process can help establish wise guidelines as you try to work through this process. And so our process is this. We do fundamental analysis. That is a decision, do we even like this index, this industry, this security? Do we like it? Secondly, we do technical analysis. Do we like it enough to have it now? to buy it? Is it something we want in our mixture? Multiple time frame analysis, looking at periods of time, 1 year, 3 years, 5 years, 10 years. How did it perform, and does it match what we're looking for with the growth and income, the aggressive or conservative nature of the security? Does it match that? Back testing it. What would it have done if we owned it? Looking at risk management. Are there any ways we can minimize risk on it to make it so that our clients can get what they need and have as little risk opportunities as necessary? And then finally, security, purchase it, like entry or exit execution, time to get in, time to get out, whatever. And so with this in mind, this is how we build these portfolios. And the sentence in the center, I just want to remind you because it's really important. Art and science of investing is an important but imperfect process for creating, growing, protecting, and preserving wealth. Again, if anybody could do it right, you would assume somebody like a Fidelity, a Vanguard, a BlackRock, a State Street, you would assume anybody could get it right every time. They would just corner the market. And so it's a strategy, it's an opportunity, it's a process. And like you, we're working very hard to make sure that process works in the best way possible for you and your family and your financial future. And these tools I've been sharing with you is how we do that. So one last thought. After all of this discussion for the last roughly 3 months, I think, I want to share with you this thought. I'm going back to the cognitive biases that I shared with you in the very first or second review I started talking about investment strategies. Conscientious advisors are responsible to honor clients' requests, even if they're illogical. Now, what do I mean by that? First of all, I do not mean that to be offensive. I don't mean that at all. If a client is sitting here, though, and they're saying, I want to invest all of my money into growth stocks, and I know they are a risk avoider, but because of something they've heard or something they've seen, they have decided this is the time. Conscientious advisors are responsible to honor clients' requests, even if they're illogical. And what that means is that if a client's pushing us to get more aggressive, then we have to take that into consideration. I would say the other is probably the bigger challenge I run into. If a client's encouraging us to get more conservative, we think that there's probably great opportunity to be more aggressive. We have to honor that. We can't just run out and invest our money aggressively because we think that's the case. That's of understanding clients' risk tolerance. And so my encouragement to you to understand by that sentence is this, is that we're a team. You're the boss, we're the employees. We share information. Your job is to bring us your thoughts, what you need, what you want, and we're trying to put those together to create the best for you. But if you're having us do something that we disagree with, we're probably going to have you sign off on it, that you understand the risk you're taking or the potential danger you're in, because we don't want to do anything to hurt you. But at the same time, as a conscientious advisor, we have to be able to consider those opportunities, try to share all the details with you and get you to understand that so that you're making the best decisions possible. And when I say that, I understand you come in with confirmation bias from sources that you've looked at, or maybe you have overconfidence. I just had a potential new client come in not long ago. Huge amount of money. I'm just a huge amount of money in one security. And I said, look, I couldn't operate that way. I can't do that. If that one security has a problem, that one stock has a problem, it's going to damage everything. But they were so confident because of where they came from on this mixture. It was inherited securities. But have a responsibility to help people think through what they're doing. Some people, they're so afraid of losing money that they opportunities because of that. And that's why I went through all of these different biases to kind of help people think through how their biases might be hurting their portfolio, to the point where I would just simply remind you that chasing performance and fear of loss always risks missing opportunities. And so our encouragement is to partner with us so that we can then help make the best decisions, understanding that if you tell us this is what you want to do, we're going to maybe explain a few things and maybe have you process a few things differently. But if in the end you say, I really want to go this way, we're going to work with you to try to create that. But we're going to be watching carefully because we don't want anybody to get hurt. we're always trying to help people meet their needs, good or bad, in those processes of family wealth management. I'd remind you that with the portfolio management goals, what we have is we have your savings, we have your short-term, mid-term, and long-term goals, and we're always trying to figure out how to blend your investment strategies within these various buckets. Your cash reserve needs, checking, savings, cash reserve or money markets you have with us, your short-term goals, your mid-term, the things you're going to need in the next 6 to 10 years, and then your long-term, which are 11 plus years, which some of those things like college education, you're going to spend all that money if you have to. Capital retention, that's going to be you need to live off that money. You can't spend it all unless you happen to know the last day of your life. You got to plan wisely for that. And so we're always working to help our clients figure that out and then to blend their investment strategies within these various buckets. So now to that point, come and take a look at analysis and where we are right now. I'm going to go back to our other chart. And so here is the S&P 500 looking for the last 6 months. I'll tell you that I'm getting a lot of information right now. You may be the same. Let's get this over here so it's off. There we go. I've got some that are saying, you know, we're looking at some real potential problems out there with the economy and interest rates falling. I see advisors on television programs and YouTube videos that are like, the sky is falling, the sky is falling. Some of the data they point at certainly I would say is concerning, but I think I hear plenty of others who are like, no, I think we're probably in a pretty good spot. We're probably going to go through a lag in the summer, but with the election coming up, unless things get too crazy, it's probably going to be a pretty decent year, at least high single digits, maybe low double. But again, that's why we say proactive wherever possible, reactive whenever necessary. I can tell you that what we're looking at here, the up and down of the S&P 500, you'll notice here the green line is the 20-day moving average. And I've been tracking along here so far from last year, November, and you can see that it's been bouncing off of that 20-day moving average. And that's a pretty common behavior when the market is in a more positive trend. It's kind of hit it here, and you can see it's just riding along the top of the 20-day moving average. I'm watching carefully to see what that's going to do. It may drop below it and then come down here to the 50. I'm not really concerned about that. Now, what we're doing right now is talking in terms of technical analytics. The fundamental analytics, there's pluses and minuses out there, as with every economy. As I've shown you the airplane before about unemployment and interest rates and such. But the economic data is favorable. Certainly policies and administration are concerning, but I don't know that's going to hit us this year. So technical analytics say at this moment, thinking that we're going to continue to hold in the particular pattern we're in, which is based upon your risk tolerance, you know, either growth in income, conservative growth, or aggressive. I'm comfortable to stay there and not move back to a safer position at this point. But if that changes in the next 30 days or 90 days or 180 days, we will certainly redress that at that point in time. So for the moment, I'm feeling pretty about it, and hopefully you are too. If you are not, as always, you just give us a call. Be happy to go over any of the data that is inside of your portfolio so we can take a look at everything and say, hey, you know what, let's make these adjustments, or, you know, everything is fine, or let's get you to a safer position based on what your concerns are. So again, we're always available for those conversations. But as of this moment, I'm feeling like we're still above that 20-day moving average. That leaves me, from a technical analytics viewpoint, feeling pretty decent about where we are right now. So as a reminder, the fiduciary standard of how we operate here, we identify the 3 phases of your financial journey: the pre-retirement or accumulation phase, the post-retirement or decumulation phase, or the end of your life, death, transfer phase. And so we're working with each of you to help you build wealth, and then once you retire or redirect, to start pulling wealth out to meet your lifestyle needs and to achieve your desired return on life. Nothing has changed on that. We still continue that. spent in previous months talking about the financial planning process we use to help answer these 3 phases. We'll continue that discussion in upcoming meetings. Again, I'd remind you that your retirement-mentality, being able to envision your return on life, is critical. Sometimes we're so caught up in the day-to-day and that 40 or 50-hour rat race that we don't really know what we're going to do once we retire. And my encouragement to you always is figure out where you want to go, and let's build everything to get you to that return on life that you want, considering the possibilities and not just staying where we are, but moving forward to the future you want and that destination you desire. That's why we do the planning the way we do it, with your return on life on the top where you're sitting, and then your investment strategies, your risk mitigation solutions, and your personal financial plan and retirement readiness, making sure those pieces are in place so that you can have confidence as you grow, protect, and preserve wealth to meet your short, mid, and long-term needs. Our website has resources here for you. Hopefully by now, I don't know if we have any guests on here tonight, but for those of you who've seen this plenty of times before, your financial dashboard where you can get all of your information, your portfolio dashboard, which shows you how we're handling things, your Riskalyze, which is now called Nitrogen. We got to get that changed with the new logo. That's your risk reward assessments. And then your financial life plan is how we tie in your feelings and desires to the facts and figures of the previous 3. Please use those. They're there for you. These tools are available 24/7, 365, and they provide you great opportunities for information. In with the planning clients, the meeting every 4 months to go over everything. We really work hard to help you make sure your spring planning is working right, your investment insurance plans are maximizing what they need to do for you and minimizing fees and expenses at the same time, and then taking a look at the end of the year for tax planning and estate design to make sure your taxes are as low as they can be today and in the future, and your estate design and beneficiaries are set up like you want it to be. This is all part of the process, what we do to help you make the most of what you're doing and accomplish that goal you have for your family's financial future. Again, our weekly updates, hopefully you're getting those. I know we had a couple of them where you've made comments to me. Please, if you know somebody that could benefit from those, share it with them. We're more than happy. It's that we work with, and we'd love to share that with others. So some final thoughts for today. Continue monitoring the economic and market conditions. As always, we're a partnership, so if you see something, say something. Let us know what's going on. We'll be more than happy to share our thoughts, and you might be just that thing that changes, that statement might be the thing that changes what we're doing or making adjustments for other clients as well. Number 2, recognizing your risk tolerance and investor biases helps us help you develop a more successful investment solution for your family's financial needs. Number 3, dollar cost averaging is still an intelligent investment strategy for growing, protecting, and preserving family, especially in volatile times. Number 4, utilizing a diversified investment portfolio, cyclical management, portfolio weighting and weighting, and entry and exit strategies in that portfolio. It's essential for helping you to grow your family's wealth. Understanding your cash reserve and investment income needs is essential for us to be able to help you achieve what you need as you move through the various phases of life. Identifying your investment expectations, communicating them with us is important so that we can help you achieve the financial satisfaction that you want. And then finally, my sentence almost every time, fiduciary wealth advisory requires a dynamic financial planning strategy to help you and your family manage wealth wisely in today's complex economic environment. And that's why I do all of the things that I do. Our team does all the things they do, even to the point of this monthly meeting, just trying to give you everything you need to make the best decisions for your current and future family needs. So if you have questions, I'm going to take those in a second. Just get ready or chat your questions in the box. Our next review is going to be May 14th at 5:30, just like it is the second Tuesday of the month. We'll talk more about strategies for creating, growing, protecting, and preserving wealth, as well as the market fundamentals and analytics. So we'll go through all of that with you. I might have one more bit of the investment and insurance material I'm going to go through with you, but we are going to start moving into the thinking about how to plan wisely for the end of the year. I know you might be like, it's really early for that, but you'd be surprised surprised how much time goes, especially as the summer goes by with vacations and everybody getting busy, and it gets hard to get some things done, because we really like to start thinking ahead towards tax minimization and estate design review in about September. I know that's about 5-6 months away, but we might spend a few meetings ahead of time, a few of these reviews ahead of time focused on that. So as I told you, I'm going to go through all of the items that I said: the risk tolerance, diversification, dollar cost averaging, cyclical asset management, waiting, and utilizing entry and exit strategies. Hopefully that slide now has more meaning to you as you see why I say the things I say and what we're doing with them as it comes to helping you make decisions on how to invest wisely for your current and future needs. The market economic review, really, there wasn't a whole lot to talk about because it's still moving along nicely. I guess I'm pretty happy about that, to be honest with you, because when things don't look so nice, we want to have another conversation. So that gave you my final thoughts on what I thought you should take away from our discussion tonight. Other thoughts or questions, as always, we're here for you for that. So let me just see if we have any questions tonight. Where'd you go? Find it? That's it. Okay. I don't see any questions. Don't see any chats. All right. As I jokingly say, and I'm hopefully it's a joke, that you either are so confident with everything that you've heard and you get it all and it's working well for you that you didn't have any questions, or I've confused you so much you don't know what to ask. If it's the latter part, please send me an email or call and schedule time to come to the office, and we'll be more than happy to help get answers for your questions and help you get everything you need to accomplish what you're trying to accomplish. So with that in mind, I'm heading home to dinner with the lovely and gracious Jane, and I will look forward to talking to you soon. And until then, God bless and have a wonderful week and a fantastic weekend.